Welcome back. We have breaking economic news. The headline inflation number for the month of November has just been released, comes in softer than expected. 1.9% was the annual pace of inflation in Canada as measured by the Canadian Consumer Price Index basket of goods and services. That was versus an expectation of 2.0%. So headline inflation on an annual basis comes in 10 basis points shy of expectations and also 10 basis points shy of the October number, which was 2.0% even. Inflation on a monthly basis, so that's from October to November, was exactly flat. No growth in the Consumer Price Index over the course of that month. It's a bit of a different picture in the measures of core inflation that have been released. Those are stronger than expected. And so this sounds like a story perhaps of gasoline and perhaps food prices. Those are the main items that are excluded from headline inflation to produce the core numbers. Core median comes in at 2.6% growth on an annual basis in November. That's versus an expectation of 2.4%, and it's more than the 2.5% that was initially reported in October. And core trim, another version of core inflation, comes in at 2.7%. That's also higher than the 2.6% that was expected. So you get the picture. Headline inflation softer than expected, core inflation a bit stronger than expected. For more on these numbers, we're joined now by Charles St-Arnaud. He's chief economist at Alberta Central. He's also a former economist at the Bank of Canada. And of course, John O'Connell will be part of our conversation as well. Charles, thanks a lot for joining us. What is your immediate take on what you've heard so far?
Yeah, well, looking at the headline number, it was exactly what as I was expecting. I was expecting no change in the month over month and 1.9% for headline inflation. Where I'm a bit more surprised is what happened in the core side, where we're seeing some increase there. So it'll be interesting to see deeper what kind of components have been driving that. I haven't seen any of the details yet, but it could be a bit concerning for the Bank of Canada, especially that there seemed to be maybe some more persistence in inflation than what they would like to see.
Right. One of the headlines here I'm seeing on my Bloomberg terminal, inflation eases to 1.9%, backing Bank of Canada's dovish stance. I'm hearing that you may take issue with that, given that core inflation numbers actually came in stronger than expected.
Yeah, at the end of the day, the Bank of Canada is really focusing right now on what's going on under the hood, because headline inflation at 2% is great, or within target, but it's more what can we find in terms of information in the report that could give us some forward-looking indicator on where inflation is going. And that's where, for me, I think the next step will be looking into what is happening in the momentum of those core measures. So how much prices have increased over the past 3 months at an annualized rate, and what's the distribution and which kind of component. So is it more goods prices? So for example, could it be passed through from the weaker Canadian dollar that we've had over the past few months? Or is it more on the service side, where it could be signaling more persistence in the domestically generated inflation?
Okay, here are some of the numbers, and I'll continue to work through them, and John O'Connell will ask you a question as well. Shelter prices rose by 4.6% in November. That was versus 4.8% in October. So the pace of shelter price inflation remains elevated, but is declining, or did decline in November. Excluding gasoline, the index rose by 2%. That's following a 2.2% gain in October. Grocery prices remained elevated. Food purchased at stores rose by 2.6%. That was down slightly from 2.7% a month prior. What do you think of those numbers, Charles?
Well, from the kind of the first brush of it, it seems like it might be more on the service side that we've seen some of the acceleration. The deceleration in shelter was expected. We knew rent prices have been starting to decelerate in many of the big cities in Canada. That would at some point feed into core. We know also that the famous mortgage interest cost was also going to decelerate as the previous rate cuts starts to make their way into lower or a smaller increase in interest payments. So we're knowing that, but it's still, it feels there's something under the hood that is still, I wouldn't say concerning, but it would be interesting to put our finger on it to kind of have a better sense of where inflation is going from here.
Charles, sort of stepping away from the picking apart the numbers, which I appreciate you haven't even been able to see yet, so I'm sympathetic to your plight right now. Stepping away from the CPI print, how much longer do you think the Bank of Canada can keep pushing its agenda of lowering rates, trying to bail out the economy in Canada? You know, we've really been in a recession on a per capita basis for a while now. Mm-hmm. And here we have the Canadian dollar hitting multi-year lows. We have chaos in Ottawa. How much lower, how much more can the Bank of Canada push this? And more importantly, at what point do investors start not wanting to lend money to the banks or the government or whatever? And those mortgage rates actually stop decreasing, and we run the risk of having a bit of a currency crisis? That really, you know, the Bank of Canada really has in a tight spot. How close are we to that?
Yeah, well, I think there's a lot of an element that I could use to answer that. But I think at this point, what we're seeing is that inflation is not the issue in Canada. Yes, we have a little increase in core, but that's kind of more if we want to be really picky on those numbers. But when we look at the broad economic context in Canada, as you mentioned, it has been weak. My own estimates put that we would have had a recession at the end of 2023 if it was not for the strong population growth. So that's something to keep in mind. Consumers or individual consumers are not increasing their spending. So that means that to grow the economy or that side of the economy, you'll need to stimulate them. So that will mean lower interest rates. But as we go into 2025, we have a lot of changes to the economic landscape. And I think, I feel like the change in population growth and in demography that we're expecting over the next 2 years could have a very big impact. If we fully implement the new immigration target, we go from population growth of a bit more than 3% to essentially zero. That will have a very big impact on our level of growth, which will be definitely weaker, but also it will impact our potential growth. It will impact the neutral rate next year. So all that is pushing for much weaker interest rate going into 2025 to re-energize the economy. Is it the best way? That's the only tool the Bank of Canada has. But obviously, with Canada being on the back foot and not doing so well economically, and on the U.S. Having an economy that's very robust, it's very hard for the Canadian dollar not to continue to depreciate, or actually to continue to see that widening of the gap between interest rates between the two countries.
Okay, Charles, we're running out of time, but I do have some of the numbers that I think you were curious about. Goods inflation completely flat over the year. So the annual pace of growth in goods, 0.0%. There are some different numbers on durable goods versus semi-durable goods and non-durable goods, but goods, the goods category, 0.0% was the annual pace of change in the consumer price index. Services, as I think you believed was the case, was a driver of inflation. 3.5% was services inflation over the course of the year. And the big numbers we've already talked about: food up by 2.8%, shelter up by 4.6%. The other big one is clothing and footwear down by nearly 4%, and also health and personal care up by 2.8%. Final comments, Charles?
Yeah, well, I think it seems like there might be a bit more persistence in inflation, what the Bank of Canada was seeing. As we were talking, I was updating some of my numbers on my side, and I was looking at the three-month annualized change in the core measure from the Bank of Canada, and it's now at about 3.3%, so slightly above that 3%. So that means that if prices were to continue the same momentum that they have over 3 months, core inflation would have been higher than 3%. So that might start to be a bit of a concern for the Bank of Canada, but at the moment, it's something that they will probably just monitor closely.